Welcome, everyone, to What Would Peter Lynch Do?
Great to be here.
It's May 21st, 2025, and, we're starting today with a look at the markets.
Yeah, things have been a bit rough. Major indices finished down pretty significantly.
Seems like it. Analysts are pointing towards, concerns over the fiscal deficit.
And that seems to be triggering a sell-off, especially hitting those stocks with higher valuations.
Right, which actually leads us perfectly into our listener question for today.
Oh, yeah. What have we got?
Someone asked, what's a quick way to tell if a stock is overvalued?
The million-dollar question. Or maybe the save you millions question.
Exactly. So that's what we're going to dig into today. We'll be exploring Peter Lynch's insights.
Right, drawing particularly from Chapter 10 of his work, looking for that rapid method to assess if the stock's price has maybe gotten ahead of itself.
It's fascinating, too, because Peter Lynch himself, he often said investing is more art than science, didn't he?
He absolutely did. His view is that, people trained too rigidly in just quantitative stuff might actually be at a disadvantage.
Because the market's full of, all sorts of people, not always rational.
Precisely. So with that kind of mindset, let's really get into Lynch's take on spotting an overpriced stock quickly.
Okay, so where do we start with Lynch's quick method?
Well, one of his key ideas, pretty simple actually, is to just compare the price line to the earnings line on a stock chart.
Okay, compare the price line to the earnings line. Let's unpack that a bit. What are we looking for exactly?
So imagine you've got a chart, right? And you plot both the stock's price over time and the company's earnings per share over that same time. Generally, Lynch observed those two lines, they tend to move sort of in tandem. Maybe not perfectly, but in the same general direction.
Okay, that makes sense. Price follows earnings, roughly.
Exactly. But the key thing Lynch highlighted is if that price line suddenly shoots way up, significantly outpacing the earnings line.
Like a big gap opens up between them.
Yes, precisely. That divergence, especially if the price line is way above the earnings line, could be a strong signal.
A signal that the stock might be overvalued.
Could be, yeah. It suggests the market price has gotten disconnected from the company's actual performance, its earnings power.
And conversely, if the price is way below the earnings line.
Well, that could suggest the opposite. Maybe it's undervalued. It's a visual clue to investigate further.
That's a really neat visual, almost like checking a patient's vital signs. Where can people find these kinds of charts easily? The one showing both price and earnings.
Lynch mentioned that most brokerage firms offer stock chart books. He even suggested just flipping through them can be really instructive.
Just get a feel for the pattern.
Yeah, develop that intuition. You see enough charts, you start to recognize what looks normal and what looks, kind of out of whack.
Okay, so that's the visual approach from Lynch. Very helpful. Now, what about folks who like, concrete numbers? Sources like Investopedia talk about financial ratios for quick valuation checks, right?
Absolutely. While Lynch gives us that great visual tool, Investopedia does cover several key ratios investors often use for a quick gauge.
A quick gauge if the price sort of lines up with the fundamentals.
Exactly. These ratios are often a first step, maybe used alongside deeper dives into calculating the intrinsic value.
So what are some of the main ones Investopedia highlights for a faster assessment?
Well, probably the most famous one is the price-to-earnings ratio, the PE ratio.
Right, PE. Heard that one a lot.
It's calculated simply by taking the current share price and dividing it by the company's earnings per share, usually over the last 12 months. That's the trailing PE.
Okay, and there's a forward PE too.
Yes, that uses estimates of future earnings. But the basic idea is the PE tells you how much you're paying for each dollar of the company's earnings.
So a lower number might mean it's cheaper.
It might, yes. But, and this is crucial, context matters hugely. You really need to compare it to other companies in the same industry or its own historical levels.
Makes sense. A tech company's PE will look very different from utilities. What about companies growing really fast, though? Their PEs might be high naturally.
That's a really important point, and that's where the next ratio comes in handy. The price-to-earnings growth ratio, or PEG ratio.
PEG. Okay, how does that work?
It takes that PE ratio we just talked about and divides it by the company's earnings growth rate.
So it puts the PE in the context of growth.
Exactly. It's kind of asking, okay, the PE might be high, but is the growth high enough to justify it?
I see. So what's a good PEG ratio look like?
Generally speaking, a PEG ratio around 1.0 is often considered fairly valued. The price is kind of in line with the growth.
And below 1.0.
Might indicate it's undervalued. You're potentially paying less for the growth.
And above 1.0.
Could suggest overvaluation, paying more relative to the growth. But again, like PE, industry context matters. Some industries just naturally have higher or lower average pegs.
Okay, that adds another layer. PE and then peg for growth. What other quick ratios are in the toolkit?
Another key one is the price-to-book ratio, PB.
Price to book. What's the book part?
Book value is essentially the company's net assets, what would theoretically be left for shareholders if the company liquidated everything. The PB ratio compares the market price to this book value.
So price divided by book value per share.
Correct. A high PB might suggest the market price is much higher than the underlying asset value, potentially inflated.
Now, low PV, maybe potential upside. Closer to asset value.
Could be, but like the others, it's best viewed relative to peers in the same industry. Book value definitions can vary, and some industries are naturally more asset-heavy than others. Investopedia also mentions it can be seen as a solvency measure, too.
Interesting. Okay, one more for the quick checklist.
Yep, let's add the price-to-sales ratio, or PS.
Price to sales. Seems straightforward.
It is. Just the current stock price divided by the company's revenue or sales per share over the last year.
And the interpretation. Similar idea.
Pretty much. A low PS compared to industry peers might suggest undervaluation, while a high PS could indicate the opposite. It's useful especially for companies that aren't profitable yet, where PE wouldn't work.
Right, because they don't have positive earnings.
Exactly. But it's crucial to remember, with all these ratios, PE, PEG, PB, PS, they're just quick snapshots.
They don't tell the whole story.
Not at all. And that brings us back to Peter Lynch. He always stressed understanding the company's actual story, which he gets into more in Chapter 11. These numbers are just part of that bigger picture.
Yeah, going back to Lynch's core thinking, it really does always seem to circle back to the fundamentals, doesn't it? Especially earnings.
Absolutely. He puts it very plainly in Chapter 10. It always comes down to earnings and assets. Simple as that, in his view.
And that famous quote of his.
A share of stock is not a lottery ticket. It's part ownership of a business.
That one really sticks. It's about owning a piece of something real, not just betting on a ticker symbol.
Precisely. It frames the whole investment process differently. And as we talked about with the charts, that connection between the price line and the earnings line moving together reinforces just how central those earnings are.
So if you see that price line taking off way above the earnings trend,
that's your signal. That's potentially that quick indicator our listener was asking for. It doesn't mean sell immediately, but it definitely means, okay, time to look much closer here. Why the big gap? It might be overpriced.
It's really interesting how Lynch's focus on earnings in that visual check kind of connects with the PEG ratio we discussed from Investopedia. Lynch had his own rule of thumb about PE and growth, didn't he, in Chapter 12?
He did, yeah. Very similar concept. Lynch suggested that roughly the PE ratio of any company that's fairly priced will equal its growth rate.
Which is basically saying a PEG ratio of 1 is fair value.
Exactly, that's the core idea.
And he gave some guidelines too, like if the PE is less than the growth rate.
That's a PEG less than 1. He saw that as potentially indicating a bargain.
And if the PE was, say, twice the growth rate,
a PEG of 2. That, he suggested, might be unattractive, potentially too expensive. He even noted that a PE half the growth rate, a PEG of 0.5, is generally a very positive sign.
Wow, so very aligned with the PEG concept.
Very much so. Though it's worth noting, as mentioned in some of the background material we looked at, just screening for stocks with a PEG less than 1 can actually give you a lot of results.
Right, it's not a magic bullet.
Definitely not. It reinforces Lynch's broader point. These quick checks, whether visual or ratio-based, are just starting points. They filter the universe, maybe highlight some candidates, but then the real work of deeper analysis using multiple factors has to begin.
So the takeaway seems to be, use these quick methods, Lynch's visual comparison, the ratios like PE, PEG, PB, PS, as valuable initial tools.
Yes, as warning signs or opportunity flags.
But don't rely on them alone. You still need to dig deeper, understand the business, the story, as Lynch called it, to make really sound investment decisions.
Couldn't have said it better. Which brings us nicely to maybe a final thought from Lynch for today.
Okay, let's hear Lynch's thought for today.
Let's go back to that powerful one. A share of stock is not a lottery ticket, it's part ownership of a business.
That really grounds everything, doesn't it?
It does. As we wrap up, let's really remember that. Thinking about the link between a stock's price and the actual underlying business earnings. It's not just key for investing.
I mean, it applies more broadly.
I think so. It's about understanding real value versus just surface appearance, which is, well, pretty relevant in many parts of life, wouldn't you say?
That's a great point. It connects investing principles to a wider wisdom. Okay, well, thank you for joining us for this deep dive into what would Peter Lynch do.
My pleasure.
We really appreciate you tuning in today. Hope you found it useful. Have a great day.